Do you know that starting your investment journey with 200 Ghana cedis a month at age 20 will leave you more money after 20 years than someone who waits 10 years later and start with 500 Ghana cedis? In this video, I'm going to share with you why time in the market usually wins and why timing the market to invest usually does not go well, especially with beginner investors. Time in the market simply means investing consistently and staying invested for a longer period of time. Whereas timing the market means you want to enter the market when prices are low and buy and sell when prices are high. So that's the difference between time in the market and time in the market. Let us look at two individuals, Kofi and Kwame, who are both 20 years old. Kofi starts investing at age 20 years. Then what he does is to contribute 200 cedis monthly to his portfolio for another 20 years. So let's say that at an interest rate of 18% per annum, an average interest rate of 18% per annum, that is how much Kofi earns from his investment. We will realize that at age 40, Kofi would have made over 380,000 Ghana cedis. And the interesting thing is that only 48,000 of that amount comes from his contribution. The rest comes from the interest he makes by investing. So the time in the market allows him to make more money, allows his money to compound, and therefore he makes money by investing longer term. Let us look at Kwame, who starts investing 10 years later after Kofi had already started. Then to be able to catch up, Kwame starts with 500 Ghana cedis. So let's say with the same interest rate of 18%, by the time Kwame is 40 years, he would have made around 150,000 Ghana cedis, and 60,000 of that comes from his contribution. So we realize that in these two scenarios, although Kwame's contribution is a little higher, that is, his monthly contribution is a little higher, which is 500 Ghana cedis, because he waited 10 years later, the total amount Kofi gets from his investment, that is his contribution plus the interest, is far above how much Kwame makes. And that is why time in the market and compounding usually work in favor of investors who start early than those who wait and start later. So starting early is good, especially for long-term growth, for people who are investing for a longer term. Let us now look at timing the market. I've already mentioned that timing the market means that you want to enter the market when prices are low and buy the financial product and sell it when prices are high. In most cases, it usually does not work as planned or as we would want it to work for us. I will give you two main reasons why timing the market usually does not work, especially for beginner investors. The first thing is that investors are likely to buy financials when price high in attempt to time the market. And why does this always happen? It happens because in cases, the shares of companies or financial products become attractive when their prices are already high. When prices are already high, the company is doing well. That is when you will actually hear about the company. That's when you actually hear the prospects of the company. So you may hear it from friends. You may read the news about how the company is doing well. So you want to take advantage. You also want to profit from the fact that the company is doing well. So by the time you are buying the financial product, the share price probably is at its peak, about to come down. But because the company is doing well and the share price of that company is doing well, you just want to also take part in profiting it. So you buy it when prices are high. And the other angle to it is that you are likely to sell when prices are low. And why does it happen? We already said that you are buying it at higher prices because the shares look attractive. But when it starts to come down, because you already bought it at high prices, and usually they say whatever goes up will surely come down. So when prices begin to come down, most investors, especially beginner investors, begin to panic. So they begin to think that they've made a mistake. So what do? They try to salvage the little that is left before the market crashes. So that is why they sell it at lower prices a price lower than how much they bought it. So in your attempt in the market, you are likely to facts not benefit from the price changes in the market because you buy when prices are high and sell when prices are low. Another reason is the fact that there are so many factors that affect the financial market. There are so many factors that affect the share prices of companies. They affect the companies and their share prices, ranging from global factors, national factors, and sector-specific factors. For instance, recently, the Iran-US conflict could affect the companies, particular companies listed in the Ghana Stock Exchange, especially companies that deal with the energy sector, because we import oil and we are part of the global energy sector. So it will affect companies in the stock exchange of Ghana, although we are not in Russia, we are not in Iran, or we are not in the US. But when investors want to invest, they do not take these factors into consideration. Other factors like national factors, for instance, the domestic debt exchange that Ghana did in 2022 affected companies listed in the stock exchange. Sector-specific factors, for example, if the banking sector is not doing well, it could affect companies that are in that sector which are listed in the Ghana Stock Exchange. So, but when investors want to invest, they only make analysis such as technical analysis, charts analysis, but forgetting or not knowing that there are other important factors that affect the financial market or the stock market. So they make a narrow analysis, and that informs them when to buy and when to exit. And because they do not take into consideration all these factors, they will lose in the market. The market will not work in their favor. That is why timing the market usually is difficult, especially for beginner investors, whereas time in the market usually work in favor of investors, especially in the long term, because of compound interest. If you find this video helpful and educative, don't forget to like, share, and subscribe to my channel. Thank you, and I will see you